You've probably heard the words bull market and bear market thrown around on the news in finance videos by that one guy at work who acts like he works on Wall Street but definitely doesn't. And if someone put a gun to your head right now and said, "Explain what a bull market actually is," could you do it? Most people can't. They'll say something like, it's when the market goes up? And yeah, technically, sure. But that's like saying a hurricane is when the weather gets bad. Technically correct, completely useless. Because here's what nobody tells you. Understanding bull and bear markets isn't just trivia for finance nerds. It is the single most important thing you need to know before you put a single dollar into any investment, ever. And today, we're going to actually understand it. The real definition, the real history, and most importantly, what you should actually do when you're in one. Let's get into it. All right, let's start at the very beginning. A bull market is when stock prices rise by 20% or more from a recent low, and that rise is sustained over time. Not just a good week, not a good month. A real, sustained upward trend where the economy is growing, people are employed, companies are making money, and investors are feeling genuinely good about the future. A bear market is the opposite. It's when prices fall 20% or more from a recent high, and that fall is sustained. The economy is slowing down, unemployment is rising, companies are struggling, and investors are collectively panicking. Now you might be thinking, where do the names even come from? This is actually one of those things where no one is entirely sure. The most popular theory comes from how each animal attacks. A bull thrusts its horns upward. A bear swipes its claws downward. Markets go up in a bull market. Markets go down in a bear market. That's it. That's the whole thing. The people who invented financial terminology centuries ago were apparently not very creative. But hey, it stuck. One important distinction before we move on. A bear market is not just any bad day in the market, not even a bad week. People hear the S&P 500 dropped 5% in a day and they start acting like the apocalypse is here. That is a correction, not a bear market. A correction is a drop of 10% to 19.9%. A bear market only officially begins when prices fall 20% or more from their peak, and it stays there. This distinction matters, and we'll come back to exactly why in a bit. Now let's talk about what the data actually says, because this is where most people's understanding completely falls apart. Ask the average person how long a bear market lasts, and they'll probably say something dramatic like years. And look, it feels that way when you're living through one, but the actual historical average, 286 days. That's roughly 9.5 months. Most bear markets don't even last a full year. And bull markets, the average bull market since 1928 has lasted over 1,000 days, close to 3 years. Some have lasted far, far longer. The bull market that started after the 2008 financial crisis and ended with COVID in early 2020 ran for 11 years straight. The S&P 500 rose roughly 400% during that period. That is one of the greatest wealth-building windows in modern financial history. And a huge number of people sat on the sidelines the entire time because they were still too scared from 2008 to get back in. That is the real cost of misunderstanding markets. Now let's look at the bear markets themselves, because the actual numbers tell a very different story than the panic does. The dot-com crash from 2000 to 2002, the Nasdaq dropped a brutal 78%, and the S&P 500 fell 49%. That one stung, and recovery took about 7 years. The world was falling apart. People were panic selling everything they owned. And if you just did nothing, you ended the year up 18%. The pattern here is impossible to ignore. So if the data is this clear, if bear markets are historically short and bull markets historically long, why do so many people still make terrible decisions during both? 2 reasons: recency bias and media. When you're in a bear market, it feels permanent. The news is bad every single day. Your portfolio looks like a crime scene. You start thinking, what if this is the one that never recovers? And so you sell, you lock in your losses, you move everything to cash, and then, because markets are deeply cruel and have a fantastic sense of humor, the market turns around almost immediately after you do. In other words, the best days happen when things look the absolute worst. And if you're sitting in cash because you panicked, you miss them. Missing just a handful of the market's best days can cut your long-term returns in half. Here's what I want you to take away from this video. Bull markets and bear markets are not just finance vocabulary. They are the two emotional extremes that the market moves between. and how you behave during each one will determine whether you build wealth or slowly destroy it. The data is on your side if you stay patient. Bear markets average less than 10 months, bull markets average nearly 3 years. The market has recovered from every single crash in recorded history, and the investors who built real wealth weren't the ones who timed things perfectly. They were the ones who stayed in the game long enough for time to do its work. Stop watching the news every day. Stop checking your portfolio every hour. Make a plan when you're calm, stick to it when you're not, and let the market do what it has always done. And if you found this useful, and I genuinely hope you did, subscribe, because we've got a lot more of this coming. See you there.